Director for the Sonoma State University Alumni Association. We appreciate you joining us for today's program, Investing Basics, which I think all of us can definitely always use some helpful information there, which is presented by Redwood Credit Union and the Sonoma State University Alumni Association. Sonoma State University is proud to have a wonderful relationship with Redwood Credit Union, and I'd like to take this opportunity to personally thank them for their collaboration and partnership. Redwood Credit Union provides financial wellness education for our students, alumni, and campus community. Today's presentation is being recorded. The recording, as well as a post-event survey and the recording, will be emailed to you following today's program. Thank you to all of those who have already sent in questions. If you think of any questions during the presentation, please go ahead and get them to us in the Q&A feature. We'll have about 15 minutes at the end of the presentation to answer questions that come in today. And before I introduce our featured speaker, I'd like to first introduce Ren Valentine. Ren is a financial wellness advocate with Redwood Credit Union and is a proud SSU alumni. I always love saying that, Ren. And she always loves coming back and working with Sonoma State. With experience in everything from new accounts and loans to financial assistance during the Great Recession and stops in between and since, Ren has been in financial services for nearly 2 decades. A passion for education and a firm belief in Redwood Credit Union's mission and vision led Ren to her current role as the financial wellness advocate, a position that allows her to work with individuals, nonprofits, students, and employers around the North Bay as they pursue financial well-being and create a life they love. Ren will be facilitating questions at the end of our presentation today, and she'll do the welcome at the beginning. Next, I have the honor of introducing today's speaker, Michael Ryan, who's a financial advisor as well with Redwood Credit Union. And we're very fortunate, he is also a proud SSU alumnus. So welcome, Michael. Michael joined Redwood Credit Union as a financial advisor in 2017. He coordinates the financial affairs of individuals, families, and business owners throughout Marin and Sonoma County. With a holistic investment philosophy, Michael strives to understand a client's complete financial picture before recommending solutions. He educates his clients to help them make better decisions about their financial affairs. Prior to joining Redwood Credit Union, Michael was a financial advisor and relationship manager with some of the nation's largest financial firms. Thank you, Michael, for joining us as well. And at this time, Ren, I'll go ahead and kick the program over to you to get us started.
Wonderful. Thank you so much, Tiffany. As you mentioned, it is true. I love every time I get to come back and be with the Sonoma State community. It's truly near and dear to my heart personally and certainly professionally. As is today's topic. In my role as the financial wellness advocate, a lot of what I talk about is the very basics. Budgeting, cash flow, all that kind of stuff. But at some point, hopefully, the goal is, I think for most of us, to get beyond those very basics and look at what are the opportunities? Where do we have room to grow? And how can we do that? Have our money work smarter, not harder. Investing is potentially one of those areas. And it's also one of the most perhaps one of the least understood topics out there. So glad to have Michael here today. Thank you so much for joining us. And we just really look forward to hearing more about how we can start to engage in investing, some terminology, some concepts that'll better serve us as potential investors, or even some of us might be more like intermediate investors, and your insights on what's going on in the market. It's never dull, that's for sure. Mm-hmm. So your insights are very much appreciated, Michael. So with that, I'm going to turn it over to you and listen and learn.
Well, thank you very much. Very happy to be here. So again, this is going to be, investing basics. We'll definitely go over some fundamentals and then just kind of get in some real world examples. So one of the most important things to kind of start out with is where we are. So 45% of people are at risk of not having enough in retirement. 68% of people are not participating in an employee-sponsored plan like a 401k. 401k is one of the most simple ways to get money into the market and invested, because you are able to take tax deferred money out of your paycheck and put it into a savings vehicle. And if your employer matches, it's free money for you. So with these two statistics though, 75% are confident in what they are doing to plan for retirement. So definitely shows that there continues to be a little bit of a disconnect between what the average investor is thinking and what the overall industry is seeing. More than 1 in 3 American seniors age 65 and up is going to rely on Social Security as their only source of retirement income. So if we take the full retirement age, which for most people is going to be 67, back in 2014, that was $2,642 per month, or $31,704 for the year. Fast forward 7 years, and it's gone up about $500. It's gone to $3,148, or $37,776 annually. Now, I don't know where you all are in life, but I can say pretty confidently that unfortunately $3,148 wouldn't even cover my mortgage or my property insurance. So again, shows that we definitely need more forms of income in the future. Also, the average increase since 2010 has only been about 1.5% per year, and some years it has not gone up at all. So again, it's not something that is going to be seeing drastic changes. So why should you invest? So if you were to put $250 into an investment every month, that'd be $3,000 a year, and you did that for 40 years, that'd be $120,000. Now, using historical average for cash, it's at 3%. That's a little bit far-fetched nowadays because cash has barely done more than 1% for the last 20 years. But if you go back to some of the hyperinflation we saw in the 80s, where CDs and savings accounts were giving you closer to 8 to 10%, using a 3% cash average would mean you would almost double your money over 40 years though. If you were to put it into something like bonds, you would see around $550,000. And if you were invested in the stock market using the S&P 500, which is the 500 largest companies on the US stock exchange, you would see an average return of roughly 10%, which means your money would go up to $1,674,071. And again, that would be if you stuck all of your money in stocks, all of your money in bonds, and all your money in cash. So ideally, you have a good mix of them all. I'm sure we've all seen this before, but we'll just kind of go through it quickly. So Mary starts investing at age 25. She puts $2,000 per year away for 10 years and then never invests again. So she puts away a total of $20,000. Her account eventually grows to $314,870. John, on the other hand, starts investing 10 years later at 35. He puts $2,000 away for 30 years and stops. Therefore, he puts away $60,000. Over the same timeline, although he invested for 20 years longer and added an additional $40,000 up to the age of 65, which for Mary would have been a 40-year time horizon, and for John would be a 30-year time horizon, those extra 10 years, even though Mary never added another penny to it, would equate to 22% more. And that is using as you'll see on the bottom there, a 8% annual compound, which again, going off the S&P 500 at 10%, is a realistic number. So traditional investments, you have stocks, you have bonds, you have mutual funds, and you have ETFs. There's many other investments within that, but those are kind of the main ones that you would see when you begin your investing careers. So what is a stock? It's ownership or equity in a company. So therefore you are a shareholder. Obviously, because it is a stock, you would see price variability. As the stock goes up in price, you'll see your assets go up. Unfortunately, as it goes down in price, you'll also see your asset drop. For most portfolios, this is typically considered the aggressive portion of the portfolio because it is in the market. However, that's up to some interpretation. There are some people out there that would say, heck, if I've got companies like Apple and Google and Microsoft and Home Depot and Lowe's, if I hold those long enough, they're somewhat risk-free because they are those staple companies in the economy. But again, almost all investing, you want to have a long-term time horizon viewpoint. So what is a bond? This is going to be typically considered your more conservative allocation. It's a fixed income. Essentially, it's a loan. You give somebody money, and what they're going to do is pay you interest. There's different maturity dates, and obviously in a typical yield curve, you would expect if I were to lend somebody $1,000 and say, just pay me back in a month or so, they're probably going to pay me back $1,000. Maybe they'll throw in an extra dollar or so because they only borrowed it for a month or so. However, if we were to go out 30 years, I'm going to say, hey, you better pay me quite a bit more. I'm giving you $1,000 for 30 years. So in a typical yield curve, the longer you're able to go out, the more interest you're going to get paid. This, again, is considered the more conservative allocation because you typically could put your bond investments in things like the US government, California, or other municipalities or companies. This does not necessarily mean risk-free. Your hope is if you give money to the US government, they're probably going to be able to pay you back. However, there are certain bonds that are high yield, which means you're taking a little bit more risk. But because you're taking more risk, they're going to have to pay you a higher reward, which would be more interest. The negative, though, would be if a company goes under, they might not ever pay you again, and you actually could see losses. So again, even in bonds, which are considered the safe investment, you want to have a good mix of conservative allocations and maybe a little bit more aggressive ones to capture higher yield. So what is a mutual fund? Exactly as the name entails, it's a mutual funding of money. So it's a big pool of money. It typically has an investment objective. It can be growth, it can be dividend paying, it could be a blend, it could be large cap, which are large companies, it could be small or mid cap, which are smaller companies, it could be international, it could be emerging market. There's a lot of different types of investment objectives out there. These are typically professionally and actively managed, which means there are portfolio managers that are making the day-to-day decisions. Maybe they're going to sell Coca-Cola and buy more of Hilton hotels. They're going to buy more airlines and they're going to sell more of Netflix. They're making the day-to-day choices, but they have to stay within the parameters of the fund objective. It is bought throughout the day, but it settles at market close, and therefore everyone gets the same price. This means you can't really time it. So if your particular mutual fund is down 4% and you say, "Ooh, this is a good time to buy it," if you purchase it when it's down 4% and at the end of the day, it's only down 1%, you get the same price as everyone else did. What is an ETF? It's an exchange traded fund. It also is a big pool of money. It also has an investment objective. However, it's more passively managed. So unlike a mutual fund, this one is typically going to be more like an index fund, or it's going to have a very broad-based parameter. It will be large cap growth. So they're going to purchase large growth companies, and they're really just going to kind of be hands-off with it. They'll make small changes here and there, but it's not as actively managed. This does trade like a stock, which means you can buy it low and sell it high. So if you did see a S&P 500 ETF that was down 3% for the day and you want to purchase it, and at the end of the day, it's only down 1%, if you purchased it when it was down 3, you actually saw a little bit of a gain throughout the day, even though it still ended lower than where it started the day. So one of the most important things is really going to be your asset allocation and diversification. As you saw before, there's bonds, there's cash, and there's stock. You typically want to have a good mixture of all of them. And that's where your quote risk tolerance can come into play. An aggressive portfolio is going to be mostly stock, and a conservative portfolio is going to be mostly cash and bonds. This right here shows you breakdown of different allocations over the last roughly 15 years, 2006 to 2021 year to date. You could see here that if you look at 2007, emerging market equity was the highest one. 2008, it was the lowest one. 2009, it was the highest one. 2010, it was in the top 3. 2011, it was the lowest one. And as you go across, you can see different things. You have cash, which is kind of a bright or sort of royal purple. In 2008, it was near the bottom. In years like 2018, it was near the top. The one that's in the gray with the lines shows asset allocation. This one used a combination of stocks, bonds, and cash. And you can see along the way, In good years, you saw some good growth. In some down years, you saw some negative returns. However, if you go all the way over to the right, the annualized return for a broadly diversified portfolio was 6.7%. The highest one was US large cap at 9.9%. The lowest over that term period was commodities at -4%, and cash was the second lowest at only 1.2. However, you made roughly 6.7% annualized return. And if you go to the far right column, asset allocation actually had the third lowest risk. So you had one of the middle of the road returns throughout the last 15 years with the third lowest risk. The only thing that was more conservative or lower risk was bonds and cash. So again, most financial advisors are going to really preach proper asset allocation and making sure you spread your eggs over many, many different baskets. A common question out there is, what is the difference between active and passive? I went over it briefly with kind of the idea of a mutual fund versus an ETF. But again, active is professionally managed, which means it's more hands-on. They're going to make changes based on their analysis, and they're going to try to capture higher returns or lower your losses to try to beat the market. So when the market does well, they want to do better on the upside. When the market doesn't do well, you win by not losing as much. However, there typically are going to be higher fees because of the professional management. And active historically has done better in volatile years because it allows the analysis and the analysts to do what they can do best. Therefore, on the flip side, passive is going to be more hands-off, typically mimics a major index, but that also means you're probably never going to really beat the market, because if you own the S&P 500 and the S&P 500 is up 10, well, you're going to be up 10 minus the cost of fees, which means you're going to be down a little bit. If the S&P is down 10%, you're going to be down that 10% plus the cost of fees, so you'll be lower than the market. But because of the more hands-off approach, it typically has lower fees, and it does do better in less volatile years. A common strategy is, why not use both? Let the market do what it's historically done and be more hands-off on that approach. But then let the professionals go in there and try to find the opportunities to capture the better upside or minimize your losses on the downside. And just for those people out there that have read that maybe passive always wins, here's an example of the S&P 500 versus 3 US-based growth funds. The S&P 500 is more of a large blend. However, with the tech sector, it's become a little bit more geared towards US large cap growth. The S&P, you could see, is up 213%. The Morgan Stanley fund is up nearly 900%. The Transamerica Fund is up over 1,200%, and the American Funds Growth Fund America is up about 500%. So you can see the S&P would have grown your money from 10,000 to 33. However, on the top side, the Transamerica Capital Growth would have got you to 133,000. I think everyone on this call would probably appreciate an extra $100,000 over that same period of time. But again, it shows that a good combination would probably yield good results. So what do you always hear? There's a good chance it came from this guy. This is Warren Buffett. He's widely considered to be one of the top investors of all time, if not the best investor of all time. His company, Berkshire Hathaway, has averaged a 20.5 annualized return since he has taken over. Again, the S&P's average is around 10%. And if you had invested $1,000, you would have roughly almost 25 million if you had invested in Berkshire Hathaway A when he took over. So, little fun fact. What is the cost of one single share of Berkshire Hathaway A? For reference, Amazon is above 3,000, Apple's over 100 or so. Well, one share of Berkshire Hathaway is $418,500. So if you have $500,000 lying around, you could buy one share of this and some other things. However, there are many, many large mutual funds and ETFs that have Berkshire Hathaway A, but again, because it's a big pool of money, you don't have to come up with $500,000 to get into his portfolio. Because of his success, he is considered the Oracle of Omaha, and we're going to go over some of his common quotes. Rule number 1, never lose money. Rule number 2, never forget rule number 1. In investing, not losing money is nearly as important as gaining money. Reason for that, common math, just kind of simplistic math. If you had $1 million and you lost half of your money, you'd have 500,000. It would be not too out there to say, well, if I earn back 50% of my money, I lost 50, I made 50. I'm back at zero. No. If you had $1 million and you lost 50% of your money, you'd have 500,000. If you earn back 50%, that's 50% of 500,000. That would only be $750,000 that you'd have. You actually need to earn 100% return just to get back to zero. So you can see on the far right side, if you lost 70% of your money, you'd actually have to earn over 230% just to get back to where you're at. However, if your portfolio only loses 30%, you only have to make back 43%. If your portfolio only loses 20, you only have to make back 25%. So only a fraction more than what you lost, as opposed to double, triple, or quadruple what you lost. So another common quote is, someone sitting in the shade today because someone planted a tree a long time ago. Again, that's the mindset of invest and let the investment world do what it does for you. So I don't know the age of everyone on this, but I'm assuming most of you were not here in 1930, and most likely it was either your parents or your grandparents. So you can blame them. Unfortunately, they did not plant a tree and put $1,000 in an aggressive portfolio back in 1930, because nowadays that would be worth 3.5 million. So again, what this shows is an aggressive growth portfolio is going to be all stock. An income portfolio is going to be mostly bonds and cash with a little bit of stock. And a moderate growth would be a 60-40 approach of 60% stock, 40% bonds. Either way, across the board, you can see you would have had good long-term growth, with even some of the more moderate ones still giving you a very good return overall. As you'll see, the best year returns for most of them are actually relatively close to each other, as is their worst one-year return and their annualized return. But again, the difference between earning 9.6 a year and 9.2% a year over a almost 100 years equates to almost $1 million difference. So the stock market is a device for transferring money from the impatient to the patient. Again, going back to the mentality of, you want to buy investments that you would love to hold for as long as you can and let the market do what it does. So unfortunately, we're going to see volatility nearly every year. We see a drop of about 5% every 3 months. We see a drop of 10%, which is a correction roughly every 2 years. And we see a loss of roughly 30% every 10 years. We saw one with COVID, and back in 2008, 2009, we saw one. So roughly, again, 10 years later. However, if you were to invest for 1 year, the best return of the S&P going back to December 31st of 1970 is almost 61% for 1 year. The worst return, though, would have been 2008 at minus 43%. The further you go out, the better your chances of success are. So if we go to 10 years, the best 10-year average you've ever done is almost 19.5%. And the worst 10-year was the lost decade of 2000, 2010, which the aftermath of the dot-com bubble burst, the combination of that, along with the 9/11 attacks and the 2008 crisis, led to an actual negative return over 10 years. However, if you go out 25 years, you could see in the worst return you've ever done over a rolling 25 years is 8.5%. The rule of 72 would state that you would double your money every time you get to 72. So if you made roughly 9% a year, that would mean every 7 years you would have doubled your money, which means over a 25-year period, you would have almost tripled your money in the S&P. So if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. This is the best 20 and the worst 20 days of the S&P going back over a 20-year period. As you can see, unfortunately, the top two happened just last year, as did, you see the one there in March of 2020, and all the other dates were around the 2008 financial crisis. However, as you'll see with the arrows, the best days were 1 day later. So the worst day ever in the market was on March 16th of 2020, but you can see on March 17th of 2020, it was one of the best days. Conversely, the second worst day was March 12th, which was a minus 9.5%. But the fourth best day ever in the history of the market was 9.3%. So again, the idea is do not time the market. Historically speaking, nobody has ever done well timing the market. It's always been time in the market, not timing the market. And now, in light of where we are right now, just threw up a few different quotes. So, speculation is most dangerous when it looks easiest. Keep things simple and don't swing for the fences. When promised quick profits, respond with a quick no. Half of all coin flippers will win in their first toss. None of those winners have the essentially, they're never going to assume they're going to be profitable the more and more they play the game. So, this is going to the Reddit stocks that have gained quite a bit of a following. This shows you prior to the boost that they saw this year, some of the quote babies of the Reddit and the Wall Street bets, AMC, GameStop, and Bed Bath & Beyond, all were down anywhere from 78% to almost 90%. So again, you never really want to chase heat when it comes to the market, because more times than not, you're going to get burned, and more times than not, you're going to find yourself trying to time the market. And it's kind of like double Dutch jump rope back when you were a child. You just kind of sit there and you wait to get in. And the best option typically would have been invest a long time ago and just let the market work for you. And I'm sure it would come up. This is just the price of Bitcoin going back from March of this year to July of this year. Again, that has also been a more volatile asset. So again, most professionals tell you, don't try to chase the heat. Don't go for the thing that is gaining all the traction. Stick with the tried and true strategies and options that have worked for many, many investors for many, many years. So, rules of the road. One of the most important things is pay yourself first. You'll hear a lot of people say you want to try to put away 10% of your income into savings. Nowadays, with rates being very low, a lot of people are saying you want to have a good emergency budget and balance, but you want to probably invest most of that for long-term growth. Determine your risk tolerance. If you're young, you want to be as aggressive as you're comfortable with. In 2020, a lot of people found out their appetite for risk was not as high as they thought. But one of the most important things is to keep the long-term mentality. You also want to diversify. As you saw, diversification helps you on the upside, and it also minimizes your loss on the downside. You also want to rebalance periodically. A 50-50 portfolio, which would have been 50% stock, 50% bonds at the bottom of 2009, depending on how it was invested, it probably would have grown to roughly 75% stock, 25% bonds, or 80% stock, 20% bonds if you left it as it was at the bottom of 2008. That's because rates stayed exceptionally low, which means the bonds didn't move much. And with the bull market we had from 2008 to 2020, your stock portfolio would have shifted. So if you are two hands off, sometimes the portfolio will get out of your risk tolerance. Again, think long-term. One of the key things I told all of my clients through COVID was, what are we investing for? And my clients that were in their 30s, 40s, 50s, 60s were saying, I'm investing, for my long-term growth and the rest of my life. Which then my exact response to that was, if we've put together a portfolio that we want to hold for 20, 30, 40 years, why do we want to make a knee-jerk reaction to a few months of volatility? Which also means don't panic. As a financial advisor, I like to think that a lot of people work with me because I put together great portfolios. The truth is, a lot of people work with the financial advisor because we are a soundboard and we talk a lot of people off of the ledge. Most of my clients did not sell through COVID, or the ones that did, we made small changes. Maybe we went from a 70-30 portfolio to a 60-40, just de-risk it a little bit. But again, you don't want to make knee-jerk reactions to a portfolio that you plan on holding for a long period of time. This is the Redwood Credit Union back office line. If any of you want to bring that up, this will get you in contact with one of our investment coordinators who would be able to set you up with speaking with a financial advisor. And we will go to the questions.
Always that struggle to get off mute. Thank you so much, Michael. I've been through these presentations before. I do some research in this field from time to time, and every time I learn more, and I love all the visuals, love the quotes. That Warren guy, man, he knows a little bit about a little bit. He's definitely earned that oracle of the, I can't remember the exact term, but
Oracle Omaha.
there we go. Exactly. I think it might extend beyond Omaha. So thank you for all of that. Really wonderful information. I do know that we've got a few questions that came in from the registration process, as well as a
Yes.
couple that have come in during the session. So let me just get to those. There we are. Okay. So I'm going to start off with, someone says that my job does not offer a 401k, but it does offer a 403b. I started pulling in 6 to 8% of each paycheck in with the S&P 500 as well as the Global Fund C. Are these good long-term investments?
Definitely. Yeah. So anything with a 4 and a letter is typically going to be some type of retirement plan. A 401k is typically for private companies. A 403b or a 457 is usually for schools or municipalities. But again, the idea is it is a tax deferred retirement vehicle. 6 to 8% is a great percentage. So the rule of thumb is you could technically put away $19,000 into one of these plans. Depending on where your income is, that's a sizable chunk of money. You figure if you make 50,000, that's almost 40% of your money. Even if you're making 100,000, that's almost 20% of your money on a pre-tax basis. One of the most important things I tell all of my clients is if your company offers you a match, make sure you're at least putting in what they'll match, because that's free money. In regards to the investments, that is one place where the financial advising world and the 401k, 403b world sometimes butt heads. They are great tools for accumulating your money. However, as you have probably experienced, I tell people it's like going out on Valentine's Day. You go to a steakhouse that has a lot of good options every other day of the year, and you go out on Valentine's Day and they're like, here's your 3 options. What do you want? So 401ks, they offer great menus. However, the investment world, there are tens of thousands of investments. So what I always recommend people is, yes, go with something, the S&P, the 500 largest companies, and then definitely global. As we are coming out of COVID, we are seeing a global recovery. Some countries are ahead of others. So definitely having a globally diversified portfolio would definitely serve you well.
Wonderful. Great. Let's see. Given some of the stuff that you talked about, I think that we might have a pretty clear vision of this, but just to reiterate, especially given all of the interesting things that have gone on in the market, certainly in the last couple of years, are stocks or cryptocurrency a better investment in the current market?
So, you know, a lot of advisors, they don't want to touch the idea of crypto. I tell everybody, listen, let's be real. Everything's going digital. I am sure there will probably be some type of digital currency. The tough thing is in the world we're in now, the quote fiat currency, everyone knows the dollars, the euros, the yens, you know roughly what they're worth. So as I say, if you go to the Ferrari dealership and you have $250,000, you're going to buy a Ferrari with that cash. If you went there with, let's just say Bitcoin was worth $50,000. If you went there with 5 coins and you said, here's $250,000, first of all, even Tesla has backed off of accepting cryptocurrency. But if they did accept it, there's a good chance they might call you up the next day if that drops to 40,000 and they go, looks like you shortchanged us about $50,000. Conversely, though, if it goes up to 60,000, you call them up and you go, I think I overpaid by quite a bit. They'd say, hey, tough luck. You gave us what the money was worth at the time. So that's one of the major concerns right now is there has to be essentially a stable price on a lot of these. And right now they are very volatile. One of the key differences that was actually sort of shocking was you would have thought cryptocurrencies would have gained a huge amount of profit when they actually allowed CRTs on them. CTRs, which is a currency transaction report. All banks have to file those for any transaction above $10,000. When they said we're going to start doing that for crypto, it dropped because the whole point of a lot of these digital currencies is the anonymous effect of it. However, a lot of people thought that actually would be a major boost because it's showing it's becoming somewhat legitimate. But again, the fact that it dropped because of that kind of shows that, again, we're probably still a ways out from that. So again, the stock market, it's boring. It might take you, more years to gain the amount of money. But again, if your grandparents would have threw $1,000 into it back in the 30s, you'd have 3.5 million now. Sure, there's those people that bought Bitcoin when it was worth 0.5601, and now they have more money they know what to do with. But again, it's more speculative growth.
Wonderful. Great. All right. We've got a question about investing for young children. I'd like to invest for my 3-year-old and a potential future child. What advice do you have?
Great. I have 2 young children myself. I've got a 529 established for them, so that way we can help pay for college, because that just seems like it keeps going up in price. Definitely, again, the earlier you start, the better. If you are 40 years old and your child is 5, they have one major asset you don't have anymore, which is time. You've got maybe 40 to 60 years. They very well, if they're 5 years old, they might have a century. So that amount of time will provide a lot of runway for growth. In regards to how to invest for your child, because of their young age, most people would want to be aggressive. However, again, what is this money being used for? If you're hoping to pay for their college, well, you want to be aggressive to try to capture as much growth as possible. But the last thing you want to do is see half your money potentially lose as you get close to college. So again, working with a professional to make sure that you're allocated in the proper way would be wise. But again, putting money away for your kids is always a good option. One thing that's become a little bit more of a stick point, and you probably want to talk to both a financial advisor as well as a CPA about, is the tax ramifications. There are some tax code changes that are coming into effect, as well as if you have a UTMA or UGMA account, which is a uniform transfer to minor or uniform gift to minor. Those actually work against you if you're looking to get financial aid for college. I'm assuming most people are, because you went to Sonoma State, you might still be in California. Obviously, California is a little bit of the anomaly across the country where, you could be making $200,000 and still need financial aid. So again, by being proactive and putting money away from your child, you want to make sure it's not going to affect you down the road if you think, hey, I might need a little bit of help paying for my child's tuition and I don't want them to have as high student loans.
Absolutely. The puzzle pieces and how they come together.
Yeah.
So kind of along that vein, you did recommend in a couple of different points working with a professional financial advisor, and a couple of questions came in about that. How do I choose an investment advisor? Where does one begin in that investing process? Where do I go and who do I contact when it is time for me to invest? So what are some of your best practices when it comes to engaging with a financial advisor, figuring out which one's right for you, so on and so forth?
Yeah. I mean, it always comes down to sort of what are you looking for? When I create business partners, I always want to know what is their business model. If I'm working with a state attorney, if they tell me I don't take any estate under $5 million, I'm going to want to know that. So if I send someone and says, hey, Bob passed away with $100,000, I want them to talk to you, they're going to be like, they're way under my minimum. So again, try to find the correct advisor for you. One of the reasons I left the more kind of quote Wall Street firms was they were continually upping their dollar minimum. So for example, I was at Merrill prior to Redwood, and when they said their minimum was $250,000, they really meant you had to have at least $500,000. And when they said $500,000, they really meant you had to have at least $1 million, which some people do, some people don't. And what I ran into is I had a lot of clients that had significant amount of money, but let's be real, I don't have as much gray in my hair. I'm graying a lot faster now. I have kids. But the key thing is finding, the correct advisor that's going to fit your goals and needs. If, you don't have a large sum of money, Redwood is a great option to get you started. And we have advisors that as a team, we manage over $1 billion. We have quite a few clients that have, smaller accounts. We have quite a few clients that have multi-million dollar accounts with us. So finding the right advisor, and again, if you're looking for more of the active advisor or the more passive advisor, they should be able to cater to both. Some firms are going to charge you a flat fee. You probably want to consider a firm that has the option to provide both commission-based and AUM-based. That means they'll charge you a fee when you purchase something. And if you're a young investor and you're saying, I want to purchase this mutual fund and I'm going to add to it every year, but I'm not going to touch it for 30, 40 years, there's a good chance the better option would be just pay when you're going to make purchases or make transactions, as opposed to paying a flat fee. The flat fee comes in more when you're dealing with an actual wealth manager, which Redwood does offer. But again, it's going to be more of the active approach, which, as I said, more hands-on, doing a lot more things for you, but the fee is going to be a little higher. So again, that's one of the things we always will go over is the fee structure and what kind of strategy and option would fit best for what you're looking for.
Wonderful. Great. Thank you for that. Let's see. We're going to go along with how would you fit investing into a VC fund into a typical portfolio?
And I'm assuming they mean like venture capital with that. I mean, so those are the type of funds that, it depends on really where you're coming from. A lot of venture capitalist funds, you have to be a accredited investor, which means you have to have a certain asset level or a certain income level. But again, the idea with venture capital is you're trying to get into those companies before they turn into something big. So for a lot of people that don't have the assets to get into a type of fund like that, what you could look at is look at small cap funds. Look at a company, local company for the Bay Area here, 2K Games. They went from a small cap company to a mid cap, and they're knocking on large cap. So if you owned a small cap fund, a mid cap fund, a large cap fund, you essentially would have ridden their growth from the very beginning up to where they are now.
Great. Thank you. We've got a couple different questions kind of focusing on two very popular topics at the moment. Yes, investing, but also home buying. So it's kind of a two-part question.
Yeah.
When somebody is saving for the down payment on a home, what are your thoughts on investing those funds in the meantime? And if you're trying to decide right now between buying a house or getting into the stock market, which would you feel more comfortable funneling your money into?
Yeah, that's definitely one of the toughest questions right now for a lot of individuals. And it sort of comes down to is, what is your time horizon? I had a client, she went through divorce, sold her house, said, I'm not going to buy a house for probably another 5 years. I'm just going to kind of rent. So we invested pretty much all the money she had minus her savings. And about a year later, she was like, I found the perfect house. I want to buy it. Luckily, the market had done well, so she had more money. On the flip side, I've had a prospect that, unfortunately, when I met with them back in 2017, they had $300,000 in savings. They were trying to decide what best to do with it. We went over conservative allocations into things to try to capture a little bit better growth, but they want to be more conservative because they thought they'd be buying a house in the relative future. Now, almost 4.5 years later, they still have not bought the house. And unfortunately, now things have changed. That $300,000 is going to get them a lot less house or a lot lower of a down payment. So that's one of the toughest questions is sort of what do you think your time horizon is? And the double-edged sword is the simple fact, if you stick in a savings account, you have to realize, $100,000 in a savings account, you're lucky if you're going to make $1,000. Unfortunately, that house that was worth $500,000 in a year is probably going to be worth $550,000. So you're losing the power of your money as it's sitting there. In regards to buying, obviously the market has been quite hot. It is still a great time to buy because rates are low. You can get a mortgage still in the 2 to 3% range, which historically speaking, if the market can give you 10, the market has good potential for long-term growth. However, I'm sure, again, being Sonoma County, Marin County, San Francisco, all those areas, real estate actually here is quite a good investment, as there's a lot of people that bought a house for, $200,000 that's now worth $5 million, which the market doesn't always do that either.
Absolutely. So speaking of that, the market is very high at this time. Is now really a good or one of the best, one of the worst times
Yep.
to get involved with the market?
So again, you know, what's your time horizon? If you're looking to get in for a few weeks, yeah, it's probably maybe not the best time. It has cooled off a little bit, but again, the mindset is the long-term time horizon, and saying time in the market is more important. Getting in at the highest point in 2008, you would still be up. Getting in at the highest point in February of 2020, more times than not, you would still be up if you were invested in a diverse portfolio. Again, I always liken it. It's kind of like that old school double Dutch jump rope on the schoolyard. You know, if you find yourself want to jump in, want to jump in, want to jump in, all of a sudden 15 years go by and you're like, I haven't jumped in yet. Why haven't I jumped in? Sometimes you just got to make that leap of faith.
Absolutely. Great. Leap of faith. That is sometimes exactly what it feels like. Yes. You mentioned during your slides the hyperinflation environment of the 80s.
Mhm.
How can people best defend against such environments?
So for the, again, I don't know the whole demographics of everyone on this call, but for, people who are, maybe a little bit younger, 50 or younger, a good way to fight inflation is investing in the stock market. Historical inflation is somewhere between 2.5 to 3.5%. Even a moderate portfolio that averaged 5 to 6% is keeping you ahead of inflation. For people that are maybe not as don't want to be as aggressive or want to be a little more conservative or looking for a place to maybe put their quote safe money, if they've got an extra $10,000, $15,000 saved up that they don't have a need for, there are other products you can look at. TIPS, which are Treasury inflation protection securities, they are essentially bonds that have the ability to go up with inflation and rates. So it's a way that you're not going to lock yourself in a low rate environment like you would right now. It allows for some growth. Also, too, is there has been continual talk over some products such as fixed indexed annuities and different types of annuities. So first and foremost, with an annuity, it is a long-term investment. Reason for that is you can't touch it until you're 59 and a half. So if you're 55, it's a 5-year time commitment. You're 25, it's a 35-year time commitment. So, but with that, it's a product that is linked to the market, but it provides, it's an insurance product, so it provides some downside protection. When you backdate these type of products, because it offers protection when the market doesn't do well and growth when the market does do well, it typically has beat most bond and inflationary pressures.
Right. Thank you. So if someone is experiencing some health issues and they have a sense of how long they're going to be on the earthly plane
Mhm.
at 61 years old, do you feel that a retirement IRA and retirement accounts totaling about 500,000, at what point should they be prepared to retire to enjoy the maybe 10 years or so?
Yeah. And, so one of the key things that I've always told people, with Social Security is it has been the quintessential carrot that they wave in front of you. When it came out in the 30s, well, most people weren't living too late in their 70s. So if they said, hey, try to push it off till you're 70, you're going to get even more money. Well, if you drop dead at 71, they only had to pay you for a year. So I always tell people, go to SSI.gov and look at what your benefits are going to be. And that will really give you a good idea. I've seen some situations where waiting till full retirement age equated to a good chunk of money. Waiting till 70 equated to even more. But again, if you wait, that is just less money that's coming to you. If you get an extra $500 a month, that's nice. But if you had to wait 10 years to get it, there's that negative effect. Also, I've seen some where waiting 3 to 5 years equates to maybe $100 a month, and that's usually not worth it for a lot of people. When it comes to retirement, you always want to make sure you're going to be able to enjoy it. Most people in retirement, they find they spend a whole lot of money in the beginning, kind of living their life, and then things kind of taper down, and then they kick back up later in life when health costs go up. But as most people have probably said, if you look at your grandparents, sure, maybe sometimes they've got the flashy car, but I mean, most of my grandparents drove an old Toyota from the 80s or 90s. They wore clothes that were probably from the 60s or the 70s, but heck, they still fit. So why, I have a Pico from my grandpa that's probably older than my dad. But heck, so a lot of, you find ways to make it work. So for people that are, kind of looking, a good tool is through RCU. We have a partner called Balance. They have some great tools that are available where you can get some budgeting, spreadsheets and things like that, and kind of crunch the numbers, figure out where you're at. And then again, that will dictate maybe what you have to do with your money. Maybe we look to put it into something that can provide guaranteed income if you need it, or we can put it into something to provide long-term growth. So that way, if you have that, emergency and you need an excess amount of money, or you do want to finally go on that month-long trip to Europe, you can liquidate some of the investment that has hopefully been growing for you to pay for it and not have to dip into your liquid savings.
Absolutely. And in just a moment, I will put a link to that balance service in the chat for anybody interested in accessing those online resources. And it is an ongoing personal resource as well for RCU members. So thank you so much for bringing that up, Michael. Um, we're in an interesting time, although I think that can always be said in the world that we live in that more and more companies are coming forward, social responsibility, so on, and so, technology, medical advancements, all of that. But then there's always the somewhat tried and true Coca-Cola, all those companies. So where should people be focusing when they've got these different options and they offer these different um uh points of attraction?
Yeah. So SRI, which is socially responsible investing, is something that has gained a lot of traction. The market is trying to decide sort of whether they want to consider it a separate investment style. It's almost becoming its own sector. It has also changed. It went from socially responsible investing, which was really more kind of geared around what your kind of carbon footprint was, to now ESG, which is environmental, social, and governance. Facebook being the perfect example of this. When it comes to environmental, well, they're pretty dang green. They're a tech company. They run, other than a maybe higher energy cost to keep their servers cool, they stay relatively green. But as it came to light, what they kind of do with your personal information and things like that, they actually were one of the top holdings in a lot of socially responsible investment portfolios, and they've fallen out of the top 10 to maybe even in the top 25 or 50. In regards to investment philosophies, it's just another type of investment out there. I recommend a lot of people to consider it. The world as a whole is considering it. BlackRock, American Funds Capital Group, they are not SRI or ESG by their mandate, which means they can go into oil and tobacco and alcohol if they see a major benefit of it. But a lot of the major funds are shifting gears to try to be more socially conscious or environmentally conscious because it's good business. Also, if you are a company that is quite successful, but you don't have good employee relationships, you don't have good diversity, that is things that can end up biting you in the end. So the world is being more kind of hands-on with how they go about it. But as you said, there is sort of the old adage of when times are good, people are going to drink, smoke, drive their cars, and shoot their guns. And when times are bad, they're going to drink, they're going to smoke, they're going to drive their cars, and they're going to shoot their guns. So, again, the mindset there being is if you're not invested in things like oil in 2020 was literally the worst investment, but this year it's the best. So if you don't partake in the downs, you're not going to get the gains. But again, a lot of people would consider an ESG or SRI investment a good add to your investment portfolio to say, heck, if this takes off, you have some skin in the game and it gets you out of some other investments that might continue to lose money over the years.
Great. Let's see. Let's go with, at this point, being where interest rates are CDs even worth investing in?
So the sad truth is actually CDs have never really been that great of an investment because even in the 80s, when CDs were paying an exorbitantly high rate compared to where they were. Inflation was also high. And one of the worst things of all is the bracket that you need to pay tax on it is $10.
Mm.
So if you have $1,000,000 and you make a fraction of a percent, if you make $11, you owe tax on that. So it's kind of one of those situations where CD rates are so low, they're already below inflation to begin with. And then the fact you have to pay tax on your gains if they're above $10, they're really not a great option right now. And they've never really been a great option. But of course, in the 80s, if you were making 9%, but inflation was around 12, you at least got to see a nice gain and you felt good about it. Nowadays, when inflation's 2% and you're only making 0.5%, it's all relative, but doesn't feel as good, when, especially at myself as a financial advisor, I'm talking with people that have CD balances and sort of saying, what is the need for this? What is your goal for this? And if they say, oh, I have a kid going to college next year, I threw in a CD just to try to get the best rate I could for keeping it totally safe. Perfect. That makes sense. But the person that's 25 years old and they're like, oh, my grandma invested in CDs over the last 30, 40 years and she was successful. Well, she was successful because rates were a lot different, but actually over time, she would have done better in other vehicles.
Okay. All right, we are running out of time, so I'm going to throw one more at you, and then that's
Sounds
probably going
good.
to wrap it up. If you have questions, that I think we got to all the live questions, but if I am incorrect, I do apologize. If you continue to have questions, if anything bubbles up or we didn't get to anything today, while Michael answers this last question, I will put his email address in the chat, so you are welcome to reach out to Michael directly and have your question answered. So that last question, you talked a bit in your presentation about the statistics around retirement and, doing what I do, whether you're 25 or 65, I still believe that you should be having a mindset toward retirement.
Mm.
So what are some safe to medium risk options for IRA funds?
So, one thing that I tell everybody is something like a balanced fund, which is going to be roughly 50 to 60% stock, 30 or 40% and 50% in bonds. The idea it's balanced. Historically speaking, the stock market, as you have seen, has always been where you get the best bang for your buck. But something like a balanced fund, which has the ability to go up to 60% 60% in stock, and it can go down to maybe 50% in stock, which means when the market is overpriced, they can lessen their exposure, or if the market's volatile, they can lessen their exposure. And as things look good, they can increase their exposure. I don't care if you are 18 or 108, a balanced fund has its place in your portfolio, whether it is your core holding or your more moderate or conservative holding. It is a good investment to have for anybody. For a lot of my clients, it is their core holding. If they're younger, maybe it's 30% of their portfolio. And then we have satellite holdings of smaller percentages. For my clients who are in their 50s or 60s, it's a tried and true portfolio, and maybe it's 60% of their portfolio. Then we've got more aggressive satellite holdings or more conservative satellite holdings. One of the big kind of negatives that people have with it right now is the simple fact that the bonds, or the 40% that's in quote bonds or safe investments, it's not paying anything. That is true because rates are low, but the market is doing well. And really, the most important thing that a balanced fund does is it creates a ballast against the market. So if the market is up 10%, if you're 60% exposed, you'll probably be up somewhere between 5 to 7%, depending on how it's allocated. However, if the market is down 10%, again, you only have 60% in the game. You'll probably be down 5 to 7%. So a balanced fund also provides for kind of a more smooth sailing. The S&P, it's averaged 10%, but it's also was down nearly 50% from its high in 2008 and over 40%. So with the S&P, you're going to get the high highs and the low lows. Something like a balanced fund will kind of bring your risks down a little bit. You'll never make more than the market per se when it does well, but you'll never lose more than the market when it does bad. And again, sometimes winning in the market is not losing as much. Most balanced funds got back to zero a year before the market did, because again, if you lost 40% versus losing 20%, you need to make back quite a bit less.
Wonderful. Well, thank you so much for that, Michael. Thank you for
Thank you for having me.
all of your time today. It's always eye-opening and inspiring. And now I want to get in touch with the colleague of yours that I work with on my investments and just see how things are going. So thank you for your expertise. Thank you, everybody that joined us today. We appreciate you spending your lunchtime with us. Thank you to Tiffany and to Sonoma State. Truly a family, truly a community partner. We so appreciate everyone's time and SSU's support and ongoing partnership. Thank you to all and best wishes for a wonderful afternoon.